Hey TMFG community, Carlo Cancino here with John Iaconetti. And in today's Ask TMFG episode, John will be going through a concept called When Good News is Bad News. So if you do like our content, please do subscribe to our YouTube channel. Again, give us some feedback, let us know how you feel about the videos, or just give us a like. In today's episode, John will be talking about why we shouldn't get wrapped up in all of the news that we hear or what we read online or in the newspaper and let that influence our investment decisions. Sometimes the news out there doesn't necessarily do what we think it's going to do in the market. John?
Perfect. Thank you, Carlo. So just like you mentioned, we put a pretty big emphasis here at the McClelland Financial Group on focusing on what you can control and really not letting those outside forces impact your decisions. And a big part of that is media consumption. An article caught our eye the other day that said the U.S. added 500,000 jobs for the month of January. Now, typically, that would sound like a great thing, right? The U.S. is adding jobs, people are working, people will be spending in the economy. The stock market in the U.S. fell that day. Well, the goal of the Fed and the Central Bank in Canada is to slow down the economy right now. And that is why they have raised interest rates. The relation to increasing interest rates means that citizens and businesses will have less money to spend and more of their budget should be going towards debt reduction. But when we start to hear positive news about jobs, that's the opposite, right? More people are going to be working, earning more income, and therefore having more money to spend in the economy. So it's actually counterintuitive to what the Fed and the Central Bank of Canada want to do. They want to slow down the economy, but it sounds like the economy is continuing to pick back up. We've seen the other side of this as well when a company gets bad news, but yet their stock price continues to increase. And you can kind of use the analogy that any publicity is good publicity. So suddenly, bad news regarding a company becomes good news to their stock price. So what does this tell us? Well, if good news could be bad news and bad news could be good news, maybe at the end of the day, it's all just news. What we try to focus on is controlling what we can control. And that means getting you in the correct portfolio for your risk tolerance, focusing on saving strategies, focusing on spending strategies, and really not letting outside forces impact your decisions. That's what we're going to continue to do. We'll let the news be news, and we'll let your financial plan still be your guiding tool.
John, it's a great reminder, although it sounds like a broken record, that this is the right type of advice, the consistency. We aren't getting, you mentioned it earlier, there can be bad news, which is actually good news. If job numbers actually came out and said that, there were less job starts that's the beginning of the month, then that's good news for the market. That means interest rate increases are working, slowing the economy down. But at first glance, less jobs in the market means a slowing the economy, which is typically bad news. At any rate, like John said, let's focus on what we can control. Let's not let the noise of the news influence us and our decisions. Again, that's another episode of Ask TMFG. Do subscribe to our YouTube channel. We love to see the subscription numbers going up. It makes us feel really good and people are enjoying our videos. Give us a comment. Let us know what you think about the videos. Feedback, whether good or bad. We want to make these videos more engaging for you. So give us some feedback and then, maybe some positive affirmation. A thumbs up is always nice here and there. I'm Carlo Cancino.
I'm John Iaconetti.
And this has been Ask TMFG.